1. What is an interest rate? An interest rate is the cost of borrowing money or the return on deposits provided by financial institutions. For borrowers, it's the cost of borrowing; for depositors, it's the income they earn. Interest rates are typically expressed as a percentage of the principal amount. 2. Why do interest rates change? Interest rates are controlled by central banks, e.g., the Bank of Japan or the Federal Reserve. Through monetary policy, rates fluctuate due to several key factors. Economic conditions. When the economy overheats, interest rates are often raised to control inflation. Conversely, during a recession, rates are lowered to encourage borrowing and stimulate economic activity. Price levels. Inflation. When prices rise, interest rates are usually increased to curb spending. When prices fall, rates are often lowered. Central bank policy. Changes in the policy interest rate by the central bank influence overall market interest rates. 3. Pros and cons of rising interest rates. Pros. 1. Increased income for savers. Higher interest rates mean better returns on savings accounts, benefiting depositors. Pros. 2. Stronger currency value. Higher interest rates make a currency more attractive, often increasing its value as foreign investors buy in. Pros. 2. Stronger currency value. Higher interest rates make a currency more attractive, often increasing its value as foreign investors buy in. Pros. 3. Inflation control. Higher rates curb excessive spending and investment, helping to control inflation. Cons. 1. Higher borrowing costs. Loan interest increases, making mortgages and business loans more expensive. Cons. 2. Pressure on corporate profits. Companies with debt face higher expenses, which can squeeze profits. Cons. 3. Decline in stock prices. As corporate profits are pressured and investor sentiment cools, stock prices often decrease. 4. Pros and cons of lower interest rates. Pros. 1. Lower borrowing costs. Lower rates make it cheaper for individuals and businesses to borrow, easing financing costs for homes and projects. Pros. 2. Boost to investment. As returns on savings decline, money flows into stocks, real estate, and other investments, spurring economic growth. Pros. 3. Positive impact on stock prices. Lower borrowing costs generally boost corporate profits, potentially lifting stock prices. Cons. 1. Lower income for savers. With lower interest, returns on savings accounts diminish, which can discourage saving. Cons. 2. Risk of overborrowing. Low rates can lead to excessive borrowing, which may later become unsustainable if rates rise. 5. Relationship between interest rates and stock prices. Interest rates and stock prices often have an inverse relationship. When rates increase, companies' borrowing costs rise, and investors are less likely to invest in stocks, leading to lower stock prices. When rates fall, companies find it easier to borrow, potentially increasing profitability and driving up stock prices. 6. Relationship between interest rates and savings. Higher interest rates improve returns on savings, making saving more attractive. When rates are low, However, savings earn little interest, which often pushes people toward investments or other financial strategies for growth. 7. Relationship between interest rates and investments. When rates are high, bonds offer higher yields, making them more attractive than stocks for risk-averse investors. When rates are low, low returns on savings and bonds drive investors to high-yield options like stocks and real estate. 8. Relationship between interest rates and loans. As interest rates rise, so does the cost of borrowing, impacting mortgages, business loans, and other debt repayments. Lower rates reduce the cost of borrowing, benefiting those who take loans. Interest rate fluctuations can significantly affect long-term loans, like mortgages, due to their duration and sensitivity to rate changes. Useful expressions. The interest rate on this loan is fixed for 5 years. Interest rates are expected to rise next quarter. Lower interest rates could help boost consumer spending. We need to consider how rising interest rates will impact our borrowing costs. The central bank just announced a rate cut. Our mortgage rate will adjust every 6 months. Higher interest rates may affect our investment returns. Let's review how these rates affect our cash flow. A lower interest rate could reduce our monthly payments. Interest rates vary depending on the loan term and amount. The interest rate environment is currently very favorable for borrowers. How would a 1% increase in rates impact our financing plan? We should look at fixed rate options given the rate fluctuations. Our deposits will yield more if interest rates go up. Rising rates might slow down housing market activity. We need to budget for potential interest rate hikes. Check if our existing loans are affected by this rate change. Lower rates have encouraged more people to invest. Interest rates play a big role in our financial strategy. The bond yields increase as interest rates go up.